Well, as we saw firsthand in 2016, Oklahoma's economy is no island unto itself. As part of this year's Oklahoma Economic Outlook Conference, the president of Cavanal Hill Investment Management shared the things he's watching as we head into a new year. Brian, what can we expect in the labor market come 2017?
I think that we're going to see continued improvement. The unemployment rate today is the lowest that it's been as part of this recovery at 4.6%. That's data through the month of November. It's normal to expect the number of new jobs, that growth rate to slow down. We've been averaging about 180,000 nationally so far this year. And we may tick down a little bit less than that, but that's normal for at this point in the recovery.
Our gross domestic product seems to be stuck for the past several years. It's just right under that 2% level. Do you think that can improve in 2017?
I think that it can. I think the consumer is doing everything that they can is their part. They've certainly benefited from the improvement in the job market, but it'll be corporations that I think if lower corporate taxes or corporate tax reform is able to increase investment there from corporations, I think can have the potential to increase growth rates nationally.
Where does trade fit in here? Because by all projections, we should expect a stronger dollar.
So the economy, our U.S. economy has been growing much faster than our other trading partners, particularly Europe and Japan. The value of the U.S. dollar relative to those currencies, or the value of the dollars relative to the macroeconomic factors of those countries. And because we are growing faster, the value of that dollar has been increasing. The United States is not a big exporter. Trade does not make up a large portion of our overall U.S. economy. We're more consumption-based. About 70% of the growth rate of the U.S. economy is personal consumption. Trade is 5%, something like that. So, but it does have an impact. I mean, the stronger dollar is just one little hurdle that our economy has to overcome. Even though it's a little bit, the trade is a smaller portion of the overall economy.
So if consumption is driving our economic bus, what about consumer confidence? This last election, I would think one thing I would interpret from it is that there is some dissatisfaction with the status quo.
Absolutely. And consumer confidence has been on a rising trend along with the improvement in the job situation. But there has been a lot of uncertainty out of Washington, D.C., particularly on the fiscal side with the gridlock and infighting between the different political parties. I can tell you that the U.S. stock market has already put in a strong vote of confidence in Trump, with it trading at near all-time highs. Now, it's one thing to say that you're going to do these things, it's a whole other thing to get it done. So,
the stock market has been great for investors, but what about savers? It's been a really tough few years for savers.
Because interest rates are very low, and in order to continue to generate the same amount of interest income for those retirees, they're having to put even more money into the bond market or perhaps even take more risks that they wouldn't normally be willing to take in normal times. And it's definitely concerning. We manage money and we caution investors against taking more risks than what their portfolio would allow. And I would say that today. I would be very careful today in taking more risk than what you would normally do.
For the past several years when we've done these economic outlooks, we've always talked about interest rates going up, yet they haven't. Is 2017 going to be the year?
Well, we've already seen longer-term interest rates rise about 50 basis points since the election. I think the bond market, being a discount mechanism, is pricing in a lot of the good things that the stock market has been cheering and a lot of the things that's coming from the President-elect Trump. I fully expect the Federal Reserve to go slow with raising interest rates. Currently, the bond market is pricing in 2 rate hikes in 2017. Even with the programs and initiatives that the new administration is touting, cutting taxes, you're not going to see a huge increase in the economy right out of the gates. There's probably going to only be 2.5% maybe in economic growth. Inflation is going to still probably remain low. The dollar will be strong in holding back prices. Those are all deflationary forces.
Mm-hmm. I want you to put on your investment advisor hat on. We are in this bull market right now, but oftentimes we don't see bubbles until they burst. Could we see a bubble burst?
You're exactly right. It's very difficult to detect when markets get overheated, when valuations are at absolute extremes before they get too far. We've had bubbles, booms, and bust periods for hundreds of years, and I fully expect them to continue. Now, I wouldn't say that we're necessarily in a bubble today, whether it's the equity market or fixed income market. There's parts of those markets that look very frothy, or that I think have a lot more risk versus the potential return. In both markets, the bond market as well as the equity market. So today, investors, always need to stay diversified, but I would say really, stay on top of it, keep your portfolio rebalanced, and meet with your advisor to make sure, given today's times and the outlook over to 2017, do we need to change a little bit of the overall risk that we're taking?
Yeah. Are we going against some headwinds when we talk about job growth? Because technology is definitely a double-edged sword. While it does provide us with a lot of things, it can also replace some jobs.
Right, and a good example of that is to take a look at what's happened with Walmart versus Amazon. Amazon being the new age internet retailer, and its stock price over the last 10 years has gone from about $25 a share to over $700 a share. They employ about 260,000 people.
A lot less than Walmart.
A lot less than Walmart. Walmart employs about 1.5 million people, and is in the market. And their stock price is also has only gone up, from around $50 to around $70 today. And so it used to be that Walmart was kind of that disruptor in the retail industry, coming into communities, putting some kind of small businesses out of business. Now look at what's happening with Amazon. The growth rate of business happening online has been increasing. Amazon is that retailer disruptor. And businesses are continuing to want to do more with less people, reduce costs in any way, shape, or form, and they're relying on technology to do that. So it is a double-edged sword.
And I have to add, digitization doesn't just affect retailers. No. It's affecting my industry. I hear it affects your industry as well.
Absolutely. The healthcare industry, or my industry, in the investment business, we've always relied on computer models to help us make investment decisions, pick stocks and screen investment bonds. But you even see it now on the advice side, where there are so-called robots that are set up to provide investment asset allocation recommendations for individuals. That is the trend even for the financial industry.
And many believe the economic disruption technology brings will only grow in the coming years.